Most people start the home buying process in the wrong place. They usually start on Zillow or Redfin. They'll start looking at houses and then send a random request for a showing for a property that they saw online. And I get it. Looking at houses is the fun part. But if you're serious about buying a home, that's not where the process starts. The home buying process starts with a plan. Because if you don't understand your timeline, your numbers, your financing, and what happens once you go under contract, you can easily waste time, get discouraged, or fall in love with a home that you're actually not ready to buy yet. So in this video, I'm going to walk you through the home buying process from start to finish. We're going to talk about your timeline, getting your finances in order, choosing the right agent, getting pre-approved, understanding buyer agency agreements, shopping for homes, making an offer, going under contract, inspections, appraisals, closing, and then what happens after you get your keys. If you're new here, welcome. If not, welcome back. My name is Daniel Walcott. I'm a real estate agent here in the Washington, D.C. metro area, and I help buyers, sellers, and investors make smarter real estate decisions. The first thing that you want to do is create your home buying timeline. Before you talk about houses, before you talk about neighborhoods or interest rates, I want you to answer this one question. When do you actually want to move? Sounds simple, but that one answer is going to drive everything else. If you're renting, start with your lease. When does your lease end? When is your last rent payment? Are you required to give a 30, 60, or 90-day notice? Can you go month to month? Is there a penalty if you break your lease early? If you're living with family, then your timeline is going to be more based on your savings goal or your job situation or when you personally feel ready. But either way, we want to work backwards. Let's say your lease ends in August and you want to be in your home by August. That means you probably want to close in either July or early August. And if you want to close in July, that means you have to be under contract by June. Because at least in our area in the DMV, it usually takes around 30 days to close. Some lenders are able to close quicker, and some may take longer, especially if you're using a down payment assistance program such as HPAP. But also if you're using renovation financing such as FHA 203K, or if you have a more complex transaction, it could take 45 days or even longer. But I would say 30 days is pretty much on par with what we're seeing in our area. If you need to be under contract in June, you probably want to start actively touring homes in April. And if you want to start touring homes in April, you should be talking to lenders and getting pre-approved before that. So the timeline looks like this. Start with your move-in date, then work backwards to your ideal closing date. Then work backwards to when you need to be under contract. Then work backwards to when you need to start touring homes. Then work backwards to when you need to get pre-approved by. Then work backwards to what you need to fix financially before you even apply for a mortgage. That's how you build a real home ownership plan. Because the worst thing that you can do is wait 45 days before your lease is up and say, I think I want to buy. At that point, you're going to find yourself rushing, and rushed buyers make emotional decisions. We want to make a logical decision, especially when this much money is on the line. The second step is to get your finances in order. And let me make this clear. Getting your finances in order does not mean that you have to be perfect. You don't need an 800 credit score. You don't need to be debt-free. You don't need to have 20% saved up. You do not need to have everything figured out before you go talk to a lender. But you do need to know where you stand. The main things lenders are going to look at is income, debt, your credit, your assets, and your overall ability to repay the loan. Your income tells the lender how much money you have coming in. Your credit shows the history of borrowing and repayment. Your debt, specifically your monthly debt obligation, is going to affect how much you can qualify for. And your assets are going to show how much money you have for your down payment and closing costs. And all of those pieces are going to work together. But this is exactly why I don't want buyers to randomly start paying off debts without talking to a lender first. Sometimes paying off a credit card helps, but sometimes it's not going to move the needle as much as you think. Sometimes keeping cash in your account is more important to the pre-approval than wiping out a small balance. Sometimes a lender is not going to recommend that you pay something off, but just pay it down because it could improve your debt to income ratio or increase your credit score. So before you make any big financial moves, make sure that you talk to a lender who can actually run the numbers. What you can do right now is pull your bank statements, review your monthly debts, check your credit, and figure out how much you can comfortably afford per month. And I'm not talking about what the lender is going to qualify you for, because qualifying for a payment and being comfortable with that payment is not the same thing. The third step is choosing your real estate agent. And I'm going to say something that seems obvious, but it needs to be said. Do not start your home search by randomly clicking schedule a tour on every house you want to see. That is not the strategy. It's not part of the strategy. This is how you end up talking to a bunch of different agents who don't know your goals, they don't know your budget, and they don't have any real commitment to help you win. Buying a home is not ordering something online. I don't care how easy Redfin and Zillow wants to make buying a home seem or seeing a home feel. Technology helps, but there's too much money at stake to treat home shopping like DoorDash. You need someone who understands the market, understands the contracts, knows how to structure offers, can explain the numbers to you, and most importantly, can protect your interests and guide you through the process. So how do you find a good agent? I say start with referrals, right? Ask friends, family members, coworkers, or people you trust who may have recently bought a home. Look online, check reviews, watch their content on TikTok, Instagram, Facebook, wherever, and see if their communication style and their experience is what you're looking for. Then you want to schedule a buyer consultation. A buyer's consultation is when you sit down with the agent and talk through your goals, your timeline, the type of property you want to buy, what your concerns are, and what the process looks like. Look, if you're watching this video, you're going to go into that buyer consultation with a whole lot of knowledge that most buyers aren't going to have. And so when you're meeting with your agent, you're going to be able to have a higher level conversation because they're not going to be explaining the basics to you, because that's what I'm doing right now. You're welcome. But this is important because you don't want to be meeting your agent for the first time at the house. You should know who you're working with before you start making any home buying decisions. A good buyer consultation should answer questions like these. What are you looking for? What areas are you considering? What is your monthly payment comfort zone? What type of loan do you plan on using? Do you need down payment assistance? What does a strong offer look like? What inspections should you consider? What happens after you go into contract? What could go wrong and how can we prepare for it? That's the conversation that you want to have early on. The fourth step is understanding the buyer agency agreement. In the past, a lot of buyers can go out looking at homes with agents without having to sign anything. But the real estate industry made some changes back in 2024 that now requires agents to have a written agreement with a buyer before they go out touring homes. This is a written buyer agency agreement that explains the relationship between you and the agent, what services the agent is providing, how long the agreement lasts, how the compensation works, who's responsible for the compensation, and what are the release terms if you wanted to walk away from the agreement or the partnership. One thing that I want you to know is the buyer agent compensation is negotiable. It's not set by law or the broker. It's not automatic or anything like that. And it should be discussed up front. In many transactions, at least in the DMV, the buyer agent's compensation can be paid for by the seller or the seller's broker. But even if that's the case, it needs to be negotiated and written into the sales contract. In some cases, the seller may offer compensation. In other cases, they may not. In some cases, you as a buyer can ask for a seller credit to cover the cost of that compensation. And in some cases, you'd have to come out of pocket as part of your closing costs to cover your agent's compensation. So before you sign a buyer agency agreement, make sure you read, understand it, and have that conversation with your agent. The agreement is not something to be afraid of. It's just something for you to understand as you go through this process. Because once you understand the relationship, the expectations are clear on both sides. Step number 5 is getting pre-approved. Your lender is one of the most important people in this process. Now, as a real estate agent, I'm going to help you find and negotiate terms on the property. But the lender's job is to help you figure out the financing, what you can afford, and if it makes sense for your budget. That's your team. You're the quarterback, you got the wide receiver, you got your running back. Everybody needs to be working together. If your lender and your agent aren't on the same page, it could create problems. Now, when you're choosing a lender, you have options. You can go to a big bank such as Bank of America, Wells Fargo, or Chase. You can go to a credit union. You can work with a local mortgage lender. You can work with a mortgage broker or an online lender. Each option is going to have pros and cons. Big banks may have competitive loan products and interest rates, but sometimes their service and their responsiveness are not where they need to be. Credit unions also have good rates, but they also may not move as quickly as we need. And I find some of the programs that they offer are lacking. Mortgage brokers, on the other hand, can shop for different options for you. And online lenders such as Rocket Mortgage, they could be convenient as well, but I find that their service is also hit or miss. Me personally, I'm always going to start with local mortgage lenders. I find they usually provide strong service. They have a pulse of what's going on the market locally. And more times than not, they have the ability to move quickly if we need to. My advice is to talk to 3 lenders. You want to compare rates, but the rate is not the only thing that matters. You want to compare their fees. You want to compare the estimated cash to close. So here's what I would do. I would have a property that, that you're interested, that you feel that's within your budget, and send them to the lenders that you're working with, right? Whether they're all local mortgage lenders or maybe one's a bank, one's a credit union, and one's, is a local lender, send them the same property. That way you have an apples to apples comparison on what their fees are, what your out-of-pocket expenses are going to be, what loan products you're going to use, what down payment assistance is going to be available, what the monthly payment is going to be for that property. A lot of the information is going to be the same, but you'll be surprised on how different the numbers could turn out. The other thing I want you to pay attention to is how quickly they respond, because the cheapest lender on paper is not always going to be the best lender in practice. And when you're trying to win a house in a competitive market, responsiveness matters. Now, when lenders are reviewing your application, they're going to look at your income, your credit, your debt, your assets, your W-2s, your bank statements, student loan documentation, retirement accounts, and any other documents to support your file. They want to get a full financial picture, so I highly recommend don't hide anything. A lot of people think if they hide money in a certain account, they can save it, they won't have to spend it. The lender's not there to spend all your money. Having more assets is only going to improve your chances of getting pre-approved or increasing the amount that you could get pre-approved for. So lay everything out on the table. The lender is not somebody that you need to be hiding things from. And yes, getting pre-approved is going to require a credit pull as well. But do not let that scare you. Multiple mortgage credit checks within a 45-day window is going to count as one inquiry. So talk to different lenders and get pre-approved, have them run your credit, but make sure that you do it within that time window. Let's talk about loan options. Most buyers are going to fall within one of the four brackets: FHA, conventional, VA, or USDA. FHA and conventional, they're going to be the most popular. Conventional loans allow you to purchase a property with as little as 3% down. FHA is 3.5% down. Now, when comparing loan products, you need to figure out from your lender, what's the monthly payment? What's the interest rate? What's the mortgage insurance? What are the terms of the mortgage insurance? What are the upfront fees? What are the property requirements? Can I use this particular loan for the type of home that I want? Can I use it with down payment assistance? I want you to be able to go into these meetings having a higher level conversation so you can figure out what is the smartest financing strategy for me to reach my goals. The next step is a home search. And now we finally get to the part that everybody wants to start with, looking at houses. But notice how much work we did just to get to this point. We built a timeline. We got our finances organized. We chose an agent and signed a buyer agency agreement. We got pre-approved. We compared lenders. We explored our loan options. So now when you're looking at homes, you're not just browsing. You're shopping with a plan. Now, before you start touring, I want you to separate your needs from your wants. Needs are deal breakers, things that you need in the home for it to work out for you. Number of bedrooms, commute, school district, parking, accessibility, monthly payment, property type, location. Wants are things that you would like to have, but you might be able to compromise on it. Updated kitchen, finished basement, big backyard, open floor plan, garage, walk-in closet, things like that. Now, the more specific your criteria, the less homes you have to choose from. So remember that. That doesn't mean you should settle, but you have to know where you're going to be flexible. Because unless you have an unlimited budget, the perfect house, in the perfect location, in the perfect condition, may not exist. And remember, your agent's job is not just to open doors for you. They're also there to help you understand the trade-offs. If you want more space, maybe you move further out. If you want a better location, maybe you need to accept less square footage. If you want new construction, maybe you need to adjust the price that you think that you're willing to pay. This is where they're supposed to step up and act as your advisor. At the very least, a sounding board for you to bounce ideas off of and maybe give you a different perspective and some advice. Next, we're going to make an offer. Once you find the right home, your agent is going to help you submit an offer. They're going to write the contract on your behalf, and it's going to include a couple things because the offer is not just the price. The terms of the offer are going to include the purchase price, the loan type, the down payment, the earnest money deposit, the closing date, the timeline, your contingencies, which include inspection, appraisal, financing, whether there's a seller credit that you're asking for, rent back terms, or any other conditions that apply to that specific situation. And this is where strategy matters because a strong offer is not always the highest offer. Sometimes a strong offer is the cleanest offer. A clean offer means a limited amount of contingencies or ways for the buyer to back out of the contract. Sometimes the strongest offer in a seller's eyes, even though it's not the highest price, maybe it gives them the most confident that you're going to see the transaction through to the closing table. And that because you have a lender that they can trust or a lender who has spoken to them and who's kind of bigged you up to say, hey, this person, they got great credit, they got a stable job, they have the money to close, we can close in 21 days, we can close in 30 days. There's a lot of things that, can go on to give the seller and the listing agent confidence that this, out of all the offers that they may have, this is the one that they should go with. Now, before we write your offer, you want to go over a couple things with your agent. One, comparable sales. You want to make sure that whatever you offer on this price is comparable with what's going on in the neighborhood. Just because a seller says, hey, I want $500,000 for my property, that doesn't mean it's worth $500,000. And it doesn't mean you should offer $500,000. But if you take a look at the comps, then you'll be able to see this property is overpriced or is underpriced or is exactly where it needs to be. You want to look at days on market. Your agent should have a conversation with the listing agent to get a pulse of the seller's motivation. What are they looking for? In their eyes, what does a strong offer look like? Especially if you're in a competitive market. You should always have that conversation. You don't want to lose out on a good house because you weren't prepared to give the listing agent what they were looking for, especially if it's no hair off your back. Once the seller accepts our offer, we're officially under contract. Remember I said 30 days? This is when that clock starts. Your agent, your lender, the title company, your inspector, everybody's going to be moving quickly, and it's going to seem like there's a lot of stuff coming at you at once. It's because it is. Everything is going to be happening at the same time. But the first thing that you want to do is send your earnest money deposit to the title company. This is the money that you're going to put down sort of as a good faith deposit to show the seller that you're serious. It's typically going to be anywhere between 1% and 3% of the purchase price. In our market, it's typically going to be 1%. So on a $500,000 home, it's a $5,000 check that goes to the title company. They're going to hold it. They're going to cash it. At the end, they're going to apply it to your down payment and closing costs. Let's say you're using a program and your down payment and closing costs are covered, then they're going to return that money to you. Now, it's important to understand your contingencies and your deadlines, because if you were to miss a deadline or back out of the contract and you weren't contractually able to do that, then your earnest money is at risk at that point, and the seller can go after that. The next thing that you want to do is schedule your home inspection. This needs to be done within your home inspection contingency period, which can be 3 days, 5 days, 7 days, 10 days. It's whatever one your agent suggests and whatever written into the contract. The inspection is your chance to learn about the condition of the property. It's not going to be a pass or fail. It's really just a factual report on what the inspector has seen. Now, depending on the home and the home's location, you may also want to consider radon tests, termites or wood destroying insects, sewer, mold, chimney, structural. These are all the different type of inspections that you can get within your contingency window. It's going to cost you, though. Without all the bells and whistles, a home inspection can range anywhere between, $600 and let's say $800. It's going to depend on the size of the home, and it's going to depend on the home inspector that you decide to move forward with. Now, while all this is happening, your lender is putting you through the underwriting process. They're going to ask for updated documents such as more pay stubs and bank statements. Don't get annoyed. Just send what they ask you for and do it quickly. During this time, the appraisal is also going to be ordered. The appraisal is typically around $600 or $700. The lender is going to order it on your behalf, but they're going to charge you for it, typically up front. Now, the appraiser's job is to provide an opinion of value for the property. I say opinion because you can have two different appraisers go out to the property and give you two different valuations. But no matter what they come back with, it's going to be one of three options. They can say, hey, you're under contract for $400,000. In my opinion, the property's worth $400,000. Perfect. You move forward. They can come back and say, well, actually, the property's worth $410,000. That's even better. You got a deal on the property because as soon as you close, you're going to have $10,000 in equity. They can also come back and say, well, the property's only worth $390,000. It's not what we're looking for, but it's also not the end of the world. What happens in that situation, if your appraisal contingency states this, which in our market it does, you can go back to the seller and ask them to reduce the sales price. The reason we do this is because the lender is only going to lend you up to the appraised value. So if they say $390,000, you're not going to get any more than that from the lender. So in order to bridge that gap, they can either drop the price to $390,000 or you'd have to come out of pocket $10,000. The contingency states if the valuation is not there and the seller doesn't agree to drop the price, you can walk away from the contract at that point and keep your earnest money deposit. It's not legal advice. That's not specific advice. Look through your contract, but for the most part, that's what the contingency states in our area. Now, while all this is happening, the title company is also at work. Their job is to make sure that the title is clean, meaning that there's no liens or judgments or any of that on the title that's going to be transferred to you. They're going to coordinate the closing documents. They're going to review all the taxes and fees and prepare all the settlement documents for you to sign at closing. Now, during these few weeks, this is where communication matters most. So check your email, answer your phone, respond to your lender, stay in touch with your agent, and please, whatever you do, do not make any major financial changes. Don't finance any cars. Don't finance any furniture. Don't change your job. Don't accept any large deposits. None of that. The underwriters that work with your lender is looking at everything, and you cannot trick them. They are paranoid because they get in trouble. If you were to default on a loan, that's on them. The bank has to pay for that. So don't try to game the system or don't do anything you're supposed to do. Before you do something crazy, talk to your agent first, and then they're going to advise you more likely than not what to do or to talk to the lender. The final step is closing. As you get closer to closing, you're going to receive the final numbers, what your monthly payment is going to be and what your out-of-pocket expenses are going to be, your down payment and your closing costs. Those numbers together is what we call cash to close. You're going to see this number on your closing disclosure. It's going to outline the loan terms. It's going to itemize your closing costs and any other important details. Before we go to settlement, though, we're going to do what's known as a final walkthrough. We want to make sure that the property is in the same condition or better than when we last saw it. So during the home inspection period, we went through the property and we negotiated with the seller for them to fix some certain things. This is when we'll go back to make sure that they were done during the final walkthrough. You also have the opportunity to do a reinspection, to have the inspector go back out to the property, make sure that everything was negotiated, was done, and if there was furniture in the property, when they were moving anything out, they didn't mess up the walls, they didn't hit anything. And so this is your last opportunity to put eyes on the property before you buy it. Because once you sign on the dotted line and you get those keys, the house is yours. There's no going back and saying, oh, I didn't see this, or oh, this and that. That's your problem now. Because the last thing you want is to skip out on your final walkthrough. Then you go the next day and you find out all the appliances are missing. I haven't had that happen, but I've heard some crazy stories. At settlement, you basically going to sit down for an hour and sign the documents. You have loan documents, title documents, the deed. You're either going to bring the money that you need to close or you would have wired it beforehand. The seller likely already signed their documents or they're going to be signing it at the table with you. The lender's going to fund the loan. You're going to get your keys, and now you are a homeowner. But even after closing, there's a couple things that I want you to do. Number one, change the locks. Transfer the utilities if you haven't done that already. Update your mailing address. Set up your mortgage payment. Keep copies of your closing documents. If you're getting a security system, it's time to have those conversations and reach out to those companies to see who's going to offer the best service and the best equipment. And make sure that you activate whatever homestead benefits your state may have for you. Typically, as a owner-occupied homeowner, you get reduced taxes and things like that. So you want to make sure that if you have to sign up for that, sometimes the title company will do it for you. If not, you want to make sure that you're signed up for that. The other thing that I want you to do is create a maintenance plan. During your home inspection, the home inspector should let you know, hey, this has X amount years left, or this is brand new, so you don't need to change this within 15 years, or maybe your HVAC system should be serviced. They're going to let you know, twice a year. Create a maintenance plan because you don't want to forget. And all of a sudden, small problems turn into big problems. And please, give yourself a financial cushion. The house does not care that you just bought it. Something is going to need to be fixed eventually, and you need the money in order to be able to do that. That's home ownership. So let's recap the full process. First, we built out our timeline. We got our finances in order. We chose the right real estate agent. And before we went out to tour homes, we signed a buyer agency agreement, and we got pre-approved. During that pre-approval meeting, we understood what our loan options were, and we got access to whatever down payment assistance is going to be available to us. We started our home search with a clear list of what our needs are and what our wants are. We made a strategic offer, and because we made a strategic offer, the seller accepted our offer and we went under contract. While under contract, we got our inspection done, we got our appraisal done, and we got our financing done. We had a successful closing. We got the keys to our property, and now you're set up for successful home ownership. And it's only the beginning, guys. If it's your first home, the process is going to seem daunting. It's going to be overwhelming. But the second one is that much easier because you did it already. You've been through it already. And then the third one, that's when we start getting into the wealth building. That's a different conversation. That's when we get into the wealth building aspect because now we have properties that we're renting out. Now we have passive income coming in. We're landlords. We're dealing with property management companies. It's another video. Don't worry about that. The biggest thing I want you to take away from this video is that buying a home is not just one decision. It's a series of decisions, and every step is going to affect the next step. And the better prepared you are in the beginning, the easier the process is going to be overall. So if you're thinking about buying a home in DC, Maryland, or Virginia, or anywhere in the DMV area, my team and I would love to help you with your home buying process. So reach out to me and do me a favor. Like, share, subscribe, and most importantly, send this video to somebody who needs to see it. Somebody who says they want to buy a home, but they don't know where to start. As always, I'm Daniel Walcott. I'll catch you guys next time.